Today I want to talk to you about a really simple lesson I learned on Wall Street when it comes to investing. It's really interesting because people get so emotional about investing and they don't think with an open mind and they don't think long term, and people get fooled by randomness all the time. And a lot of hedge funds and a lot of traders try to make money every month, and it is physically impossible without breaking the law, because each month has only 20 weekdays or 20 trading days. And so quite often you get fooled by randomness. You're wrong for the right reasons and vice versa. And what's deadly is when you make a little bit of money because of some macroeconomic event and not because of the underlying fundamentals of a stock you've invested in. And then you get really confident and overconfident, and you end up causing more damage and losing more money than you made. And so one simple way to invest or to think about it is what drives stocks higher in the long run? Like, what has a big impact? Obviously, yeah, it's earnings and a great company with a great management team and a great product cycle. But let's just think of in terms of simplistic supply and demand. So what drives a stock longer, or higher I should say, in the long run, is the big money mutual funds, because they have a lot more money than hedge funds or any other investors. And so when a big firm like Capital or Fidelity or Putnam or whatever starts buying a stock and accumulating a position, they know that they're stockholders because they're so big and they have to be in it for the long term. And they have billions and billions and billions of dollars. And so their analysts and portfolio managers think very, very long term. And okay, fine, if that's what drives stocks higher is the big money mutual funds pouring a lot of capital into stocks, among other issues, of course, and other drivers. But if that's a big driver, then let's think like that. So a lot of time, these great investors at Capital, which is based out here in California, I think they're down in LA, their headquarters are amazing. What they do is they think 5 years out. Because they have so much money, they have to invest 5 years. And it's not just Capital, it's Warren Buffett and other great investors. And Buffett, of course, invests longer term than 5 years. And so if you ask yourself one simple question, I promise you this will save you a lot of money and make you a lot of money in the long run. That question is this: in 5 years, is this company going to be more relevant or less relevant than it is today? I'm going to say it again, then I'm going to give you examples. In 5 years, is this company that I'm considering investing in going to be more relevant or less relevant than it is today? And that will stop you from buying stocks that appear cheap and are cheap for a reason. So when it comes to technology stocks, for example, I'll talk about other sectors in a second. But when it comes to technology stocks, when a technology company starts to become just a little bit less relevant, it's game over 99.9% of the time. Because in most situations, turnarounds do not work in tech and in many industries too. And so let's say a number of years ago, you were investing in my beloved Canadian BlackBerry, Research in Motion. And let's say that the valuation was cheap. It was only 7 times earnings. And you thought, oh my goodness, it's so cheap. Well, it's cheap for a reason, because those earnings are wrong. Because what happens is once a company starts becoming less relevant, like BlackBerry, in almost all cases, they can't turn it around unless the founder comes back to the company, like what happened with Steve Jobs. Okay. And so if you had that frame of mind and you thought longer term and you told yourself, in 5 years, is BlackBerry going to be more relevant or less relevant than it is today? If you asked yourself that a couple of years ago, then you wouldn't have gotten stuck in a value trap. And that's just one example, and one data point doesn't make a trend. But if we look at other examples too, like Yahoo, years ago, if you invested in Yahoo once Google went public, and you asked yourself, was Yahoo going to be more relevant or less relevant in 5 years? Then that would have stopped you from catching a falling knife and buying Yahoo, even if the earnings were cheap. And I know that there's one or two little catalysts like Alibaba's stake in Yahoo and other stocks that might drive them temporarily to go up a bit. I'm thinking longer term here. And so when you ask yourself that question, in 5 years, will this company be more relevant or less relevant than it's today? Basically what you're doing is this. You're thinking like these analysts and portfolio managers at big mutual funds, because when they ask themselves that question in 5 years, will that company be more relevant or less relevant? They're basically asking themselves, will my earnings estimates in my financial model be higher or lower than other investors' expectations? And if a company they believe is going to be more relevant, then of course their numbers are going to be higher. And by investing this way, this will stop you from, if you're new to the hedge fund industry, for example, and a widow maker, or I shouldn't say that, but whatever, a rookie mistake for people that go to hedge funds is they all short based on valuation. And they all wanted to short Amazon. Everyone's done it. Everyone's been there. I did years and years and years ago. Then finally I saw the lights, and I ended up owning Amazon for years. I made mistakes too. But if you short a stock just based on valuation, on this year's earnings or next year's earnings, that's not enough to make you a great investor longer term. You won't generate alpha. And alpha is nerd Wall Street speak for outperforming the index, the benchmark index, like the NASDAQ or the S&P or the CAC or the Nikkei, whatever country you're index. And so if you think longer term and you think that a company is going to be more relevant in 5 years than it is today, then you won't worry as much about valuation on this year's numbers or next year's numbers. And so what you'll start to do is you'll start valuing companies based on your earnings estimates in 5 years. And so there's a company I loved, I held for years, called NetSuite, which unfortunately Oracle bought because it's no longer public. Great company. Good acquisition by Oracle. But for years, people would tell me, Chris, you're crazy. Why? And I make mistakes too, but this one worked out. They say, Chris, you're crazy. Why would you own NetSuite? It trades at 100 times earnings. And I would always say, but I'm thinking about it differently, because in 5 years or 10 years, NetSuite's only trading at 2 times my earnings estimates. Sorry, England. England likes that better, right? Not that way. And if you want an example to see a write-up I did on NetSuite, and I usually do one-page write-ups on stocks or any investments before I get involved. And anyway, my one-pager, you can go to my website. It's all free, whatever. It's Haroun Ventures, all lowercase, Haroun ventures.com/template. And you can see my one-page write-up on NetSuite there and how I was thinking longer term. And there's a blank template there for you as well if you want to use it yourself or customize it yourself. It's pretty easy to fill out the template. But just think longer term. Otherwise, what happens is you become a tourist in a stock, and all you end up doing is renting a stock. And Warren Buffett, and I won't quote Buffett too many more times, sorry, but I think he's smart because he's long-term focused. The other day I told you that he had that great quote, which is, the New York Stock Exchange is the only store in the world where consumers sell stuff when it goes on sale. And if you have the 5-year question in mind, always, when you're considering investing in a company for the long term, then you won't be tempted to sell at the worst times. And I have to quote Wayne Gretzky. I'm Canadian. And Gretzky was very successful because he would say that he didn't skate to where the puck is, but rather he would skate to where the puck is going to be. And so he had the foresight to invest, or to skate to where he thought that the puck was going to be. I'm at a stop sign looking, and I'll wrap it up now. And so I want you to have the foresight to invest in stocks that other people are going to invest in as well. And if you have the 5-year test in mind, then the bottom line is that you'll do much better because you'll be a longer term shareholder and you'll outperform and you'll think like the big money accounts that tend to drive these stocks in the long run, like Capital Research. If this was helpful, and only if this was helpful, please click the like button and subscribe. Someone's behind me honking. And I will see you mañana. Thanks.